Offer for sale. So before we go for offer for sale, we must understand why a company goes for IPO. An IPO bound company helps in raising large capital for expansion of business, and there is brand visibility for the company. By getting listed and acquiring market capitalization, the company can aggressively go for acquisitions by using shares as currencies, and it also can attract employee talent and also retain them by giving them employee stock options. Subsequently, an offer for sale is where the promoters or the venture capitalists want to exit their share. It is a red flag if the promoters are selling their stake or share in the offer for sale in the IPO bound company. Most of the time, IPOs are disguised in the form of offer for sale, and investors should not get confused between IPO and an offer for sale. The primary market is booming, but it is most often used for the promoters to exit their shares and purchase the equity with the physical assets. If they are selling too much of their stake, then it is a red flag, and primary market investors must take note of it. Before IPO, a company can be a private limited company. After IPO, it becomes a public limited. So the first stage of IPO process is the filing of DRHP or the draft red herring prospectus. So the first stage is in IPO process is filing the DRHP or draft red herring prospectus, and after the DRHP is filed, the company is expected to complete its listing process within the next 180 days. The step 2 is obtaining the approval of the SEBI Securities Exchange Board of India for going for the IPO initial public offer. And after filing of draft redlining prospectus and obtaining SEBI approval, announcement of the price band of the IPO. Price band is the width between the lower price of the stock. For example, it can be between 300 to 350. That is could be the price band. And when the IPO opens, it should be open for at least 3 days of trading. So when the company goes for an offer for sale, then it can be a red flag for investors in applying IPO in the primary market, because many a time these IPOs, so-called IPOs, are in fact offer for sale as a vehicle for promoters and venture capitalists to exit their load and making huge profits. But the primary investors would get allotted of their shares application. But these are all not new shares. Rather, it is an existing stake held by the promoters, which is handed over to the primary investors. So, if too much of promoter stakeholding is diluted through through the name of offer for sale in an IPO, then it is a red flag, and it is a clear warning to the primary investors to not ignore the risk of investing before making an investment. So first, a draft red herring prospectus must be filed, and to obtain the approval of SEBI before going for an IPO process. So the announcement of price band, and then uh, after the application process is scrutinized whether it is oversubscribed or undersubscribed, and there could be a proportional allotment method or a green shoe option method, which can be applied in case of an oversubscription. Green shoe option is allotting more than the initial allotment process. For example, the company planned to allot around 10,000 shares, and the application has been oversubscribed by around 10 times. So, due to the overwhelming response, the company uses the green shoe option and is now allotting to 15,000 subscribers. This is green shoe option, which can be used in case of an overwhelming response to the public issue.